Good morning, everyone. Good morning. We're going to get started. We're still expecting, of course, quite a few more people who are stuck in that wonderful Boston traffic, but at least it's a delightful morning to be on the road. Welcome to Northeastern University, the DeMoore McKim School of Business, and our 2013 Center for Emerging Markets Symposium. My name is Hugh Courtney. I'm the Dean of the DeMoore McKim School of Business, and really am delighted to welcome you here today. In particular because I really love this event. This is an annual event for us, and there are a number of reasons that I really love it. First of all, and of course this goes without saying, is why you're here today. It matters. It really matters. Sometimes we can have academic meetings that oftentimes are focused on issues that probably don't matter as much as this one. I hate to say that, but it does happen. As you all know, the center of gravity in our global economy is shifting south and east towards the emerging markets. And if we as business leaders, as our students, as future business leaders, don't have a sophisticated and evolving perspective on these markets and what they mean for everyone, well, shame on us. So it matters. Thanks for investing in something that matters so much. Second, the reason why I really love this is that I really do think that Northeastern, the DeMoore McKim School of Business, and our Center for Emerging Markets are really the natural owners of the symposium for several reasons. First of all, as many may know, we are the number 8th ranked international business group and program in the country. We have a real collection of scholars here that focus on international business issues and have some very unique programs. And in particular, we have one of the top international business undergraduate programs in the world, and are launching a new Master's in International Management program this year, as well as working on a PhD program as well. So we really are leaders in this field, and we love to bring other leaders here to campus. It's not just the DeMoore McKim School, of course. In our Center of Emerging Markets, we have over 60 faculty associates across the university. From the law school, from health sciences, from social sciences and humanities, from DeMoore McKim. This is really a university commitment. Very importantly, it validates our commitment to what we like to call use-inspired research. And by that we mean is that we work on issues, again, that matter. The work may be and is often quite theoretical, conceptual, extraordinarily quantitative and empirical, yet it's inspired by issues that are driving our global economy, and in particular, in this case, what's going on in emerging markets. It's also kind of quintessentially Northeastern, I believe, in the fact that it involves academics, students, business leaders, consultants, public sector leaders involved in a conversation on issues mattered. Again, we like to think of ourselves as not staying, holed up in the ivory tower every day, but to engage with communities like this, because this is where breakthrough thinking and innovation occurs. And finally, it also validates our commitment to experiential learning. Symposiums like these offer extraordinary learning opportunities for our students. I'm delighted to see several of you here today, and hope you can knock off your other classes and spend most of the day with us. You have my permission. This is an extraordinary opportunity. I really do believe that. And it's the spirit of this place. We want you to dig in with people unlike yourself working on issues that matter. So, very happy to welcome you here today, and thankful to for so many. First, I want to thank Ravi Ramamurthy, who will be up here in a moment, who leads our Center for Emerging Markets, and is responsible for today's event. I want to thank the speakers. One and all will be introduced and thanked along the way, but we have an extraordinary lineup, as I think you well know. I want to thank those organizations that have been so generous in helping us in many ways through the years at the Center for Emerging Markets. I want to call out in particular the Associated Industries of Massachusetts and World Boston, and for others like the Liberty Mutual Foundation and the Department of Education, who have supported the Center for Emerging Markets in the past with funding, and have seen the value in its work. I also wanted to invite you to get to know more about the center and the opportunity to support it if your organizations like us really see the value of this sort of use-inspired research, and it can really further your own agendas. And there's some information in your information packets on that if you're interested, we certainly are very excited about your support and, most importantly, for having you here today. I also finally want to thank Ann Benware, who's over here on the left, who is responsible for all of us being in the room today and making this work like clockwork. Thank you, Ann. Appreciate it. So, in closing, I just wish you all a very thought-provoking, engaging day, working on a set of really use-inspired research topics that impacts all of us day to day. And I hope you develop a whole new set of relationships, insights, networks that will further your own work and your personal, pleasure. This is a real treat, I find, to be able to engage in these sorts of topics with a set of people like this. So welcome. I wish you the best today. And with that, I want to introduce Ravi Ramamurthy, who will say a little more about the agenda and welcome here today and introduce our new speaker. Ravi, thank you.
Thank you, Hugh, and good morning, everyone. I'm, as Hugh said, Ravi Ramamurthy. I'm a professor of international business in the Damore McKim School of Business and director of the Center for Emerging Markets. The center does lots of things, and you will find in on your tables a copy of a newsletter, which you're welcome to look over if you feel like, describe some of our activities. And in the folder, you'll also see a one-page blurb describing our mission. We do research. We do things to promote student learning about emerging markets. We even try to facilitate co-op assignments for our students in emerging market companies. But the third component of what we do is business outreach. And today's event is really in that sphere of our mission. As Hugh said, we are partly trying to share with you some of the insights we have gained over the years doing research on emerging markets, but equally important for us is hearing the speakers and to understand what companies are wrestling with and therefore what kinds of issues we ought to be conducting more research in at Northeastern University. A few of our faculty associates are here, and I would ask them if they would mind standing so you can see a sample of our brain power that works at the center. Thank you, guys. These are really the pillars of the intellectual activities that go on at the center. A word about today's theme for this year's symposium. I think if you're following the news, we recognize that something is starting to change about the emerging markets. Growth certainly is slowing compared to what we have seen in the recent past. In some of the countries, inflation is becoming an issue. The currencies are falling in several countries. The balance of payment situation is starting to go in the wrong direction for some of these countries. And people are starting to ask, what does this all mean for the future of these economies and for their place in the global economy? Hence, the theme for this year's program, which is looking at the new realities of emerging markets. Now, when I think of emerging markets and the opportunity in the emerging markets, I think of sort of three domains in which there are opportunities. The first is markets. I mean, these countries are obviously important as markets. They have 6 billion people. Their purchasing power is growing. It's obviously not as high as that of the other billion who are in the advanced countries. But there's 6 billion people, and this is what usually companies see when they look at these economies. So these are lots of potential consumers. But there's also enormous pools of talent, some of it still very competitively priced. And so these countries are also potentially platforms for producing all kinds of goods and services. And we've certainly seen that take off in the last couple of decades. And finally, an aspect that's not always recognized is the role of these countries as centers of innovation. And so if I'm a US company and I'm looking at these economies, these are sort of three broad domains in which I could leverage these economies to improve my own company's global competitiveness. Now, all of this is happening in a certain macro environment, and as you'll see in the course of this morning, we're going to touch on several of these topics. So we're going to start with Sara Johnson, who'll talk about the macro environment in the emerging economies. So this is really looking at these at the country level, and then filtering down from that implications for markets, sourcing, innovation, and so on. Our second session, which is now, we actually had a slight change in the program because our second speaker has an important phone call. This company is going through a major restructuring that we will read about probably or hear about soon. And so he had to move his session to follow session 3. So our second speaker, in fact, will speak about emerging economies and the outlook for offshoring to these economies and the outlook for innovation in these economies. So that's Venkat Srinivasan, who will be following Sara. And then we'll get to Merck, where we will have a look at what they've been doing in several emerging economies. Dionysius Bouzos, who is their vice president for emerging markets, has lived in Russia for 15 years. He started Merck's operations in Russia. He then built Novartis' business in India, and China actually, and then turned around their business in India, and then came back to Merck and now runs their entire business in all of the emerging markets. So he's got very, very deep experience working in these individual markets. He's based in China, he says, but he's there for 2 days every month. And we're fortunate that he spends so much time close to headquarters, which is why he's able to be here with us this morning. Now, the other dimension where all of this comes together at the firm level is when you think of it in terms of strategy. So when you start to look at how a company deals with all of these opportunities in the emerging markets at a strategic level, then you raise a different set of issues. And our fourth and fifth speakers will be focusing on sort of the bigger picture of how their companies are dealing with all of the opportunities in these countries. We've also added another element into the program, which is a student panel on co-ops in these emerging economies. We're proud of our students, obviously, and we like to show you a little bit about what their lives are like and what they're learning at Northeastern University, and particularly as we expand the co-op and give it a global dimension, including the emerging economies. So that's broadly what we are in for. To get us going now, I want to briefly introduce our first speaker. This is going to be Sara Johnson. As I said, the second speaker then focusing on offshoring and new ventures in India will be Venkat Srinivasan. And then we will look at BRICS and beyond with Dionysius Bouzos. Our fourth speaker, who's from the Harvard Business Review, will talk about why MNCs struggle in the emerging markets. So that's looking strategically at these markets. And finally, Syed Jaffrey, who's president for the emerging markets at Thermo Fisher, will close the morning, and in between we'll have for you this panel with students looking at international co-ops. So that's the agenda. Now, a word about Sara Johnson. Sara has been to Northeastern, she says, a few times in the past, but long before the campus became this beautiful. So it's great to have you back. Sara is the Senior Research Director for Global Economics at IHS Global Insight, which is a leading economic forecasting firm. And she helps clients assess the worldwide business and financial opportunities and risks. And so she's really the custodian of their economic forecasting models. They had a session, I believe, on Friday to meet and agree on what they think is the outlook for these economies going forward. So what she's presenting is literally hot off the press. So thank you, Sara, for being here. And Sara's going to talk to us about a cautious outlook for emerging markets, which I think is appropriate given our theme for this year. Sara, thank you. Welcome.
Okay. Thank you, Ravi. Reminded me that there will be Q&A at the end of my presentation. Well, certainly earlier this year, as the Federal Reserve began to talk about withdrawal of its extreme monetary accommodation, we saw a bit of some capital flight from emerging markets. Risk was off again. And with this, we saw some very sharp currency depreciations and kind of a reassessment of the future of emerging markets had we been overly optimistic. There were both cyclical and structural forces at play through this episode. Fortunately, markets have calmed down a bit since June and July, but some currencies have continued to hit record lows from time to time. And I think my conclusion will be that a lot of the dynamics are structural, so we need to have a cautious outlook for emerging markets. But having said that, emerging markets will still account for over half of the growth in the global economy. At IHS, we forecast 204 countries of the world, and we separate them into three categories. Advanced countries, of which we forecast 32, emerging markets, 54, and then 118 developing countries. That latter group accounts for less than 4% of global GDP. Currently, the advanced countries are about 61%, emerging markets 36%. And if you look at the composition of global growth, in the past decade, emerging markets accounted for about 55% of world growth. Advanced countries about 40%. We don't see a dramatic change in those proportions. Over the next decade, emerging markets will still account for about 53% of growth. Advanced countries, 43%. So emerging markets will continue to play a leading role in driving the world economy forward. But if you look at this chart, which is real GDP growth, you can see that their growth rate peaked at 8.3% in 2007. And that indeed there was a very impressive boom in the 2003 to 2008 period, in which the differential between growth in emerging markets and advanced or mature economies widened considerably. You also can see from this chart that cycles are closely synchronized. There's really no decoupling. Advanced countries depend on emerging markets, and emerging markets still depend heavily on growth patterns in the advanced countries. The Eurozone protracted recession has certainly hurt a number of countries, for example, as well as sluggish growth in the U.S. economy. Moving forward, we see growth rates picking up gradually. Global growth in our forecast is about roughly 2.5% this year. We'll move up to maybe a little over 3% next year and closer to 4% in 2015. For emerging markets, we see growth of 4.8% this year, about 5.4% next year, and 6% in 2015. So we do see some acceleration in the global economy and emerging markets, in large part driven by the advanced countries. This is kind of a unique feature in which some of the more mature economies like the United States, United Kingdom, Japan, and Germany are kind of on the leading edge of the acceleration of the world economy over the next couple of years. So if you look at our projected growth for the four BRICS, you can see that we're not likely to revisit those very high growth rates of the last decade, but we will have substantial growth led by China and India. We have India overtaking China towards the end of this decade, but more subdued growth for Brazil and Russia. Brazil has certainly had its troubles in the past couple of years, and I'll say more about that as we move on. But this kind of sets the stage. What has caused the slowdown in emerging markets? Well, let's look at a few cyclical forces. One, clearly the global monetary cycle. Despite complains about appreciating currencies during this period, clearly emerging markets benefited from ready access to cheap capital. And now we're seeing the reversal of that cycle. It's going to be a little more difficult to raise capital. For example, emerging markets will now be competing with corporate borrowers in the United States. Risk profiles might kind of favor other borrowers at this stage of the cycle. We're also after enormous policy stimulus during the 2008-2009 recession. That stimulus is being withdrawn or has already been withdrawn. That's a factor. China, interestingly, over the past few months has announced some 10 trillion yuan in new stimulus programs. That exceeds their 2009 stimulus, but it is spread over the 2013 to 2020 period. But that certainly has been a force in stabilizing China's growth rate. Weak export markets have been a factor. Excess capacity after investment booms. In a number of countries, we've seen a pronounced investment cycle. Brazil is one example. Fixed investment declined significantly last year and is now beginning to recover, but at a fairly disappointing pace so far. In China, excess capacity is a major concern. 19 industries have been singled out for capacity reductions. A number of the metals industries, paper, glass, you name it. But structural forces, I think, are should be the key focus in assessing this slowdown in emerging markets or this reassessment of growth prospects. Clearly, slower labor force growth is a factor in a number of economies, China most notably, where the working age population is beginning to decline. Another factor, the end of rapid globalization. I'll have a chart on that in a moment. But clearly, the emerging markets and the commodity producers among them benefited enormously by globalization. Emerging markets became platforms for manufacturing for the advanced countries. The end of the commodity price super cycle is another factor. I'll note that later. And then finally, I think there's a general consensus that many countries missed the opportunity to introduce market reforms during this kind of golden period of cheap capital. And certainly during the 2009 recession, there was some disillusionment with market economics and maybe perhaps a return to a larger state role in the economy. And that over-reliance on government is now kind of coming back to bite some of these economies. Here's a look at the pace of globalization. This is world imports as a percent of GDP. You can see that during the recession, there was about a 5 percentage point drop in this measure. But go back before the crisis. You can see that in the 2000s, there was quite a steep upward move in this, which is a measure of world trade as a share of total economic activity. This measure peaked at over 31% in 2008. It has yet to regain that peak. In fact, we think it will be 2017 before we get back to the peak. But I think our view is that globalization will proceed, that there will be opening of markets through trade negotiations, probably bilateral and regional negotiations in large part. But perhaps the golden era of globalization is behind us, and we see this in supply chains. To some extent, the internationalization of supply chains may be approaching its limit. Certainly the earthquake, tsunami in Japan, the floods in Thailand, highlighted some of the risks of overdependence on markets for specific components. Another factor, new technologies may reduce the attractiveness of inexpensive labor in some of these emerging markets. And then, of course, a number of economies benefited from the rapid increase in commodity prices, particularly in the 2003 to 2008 period. This is the IHS Index of Industrial Materials Prices, set at a value of 1 at the beginning of 2002, and you can see that in the 2002 to 2008 period, commodity prices more than quadrupled. That's the blue line. I also put in the non-ferrous metals, since that's important to a number of emerging markets. Then we had the recession and the collapse in prices. We've had some volatility ever since, but prices have not resumed their peak. And I think we would argue for two reasons that we will not have substantial price increases for commodities, and indeed commodity prices might trail the general level of inflation over the next decade. One is, of course, the supply responses to this run-up in prices. And then another, of course, is the slowdown in emerging markets growth itself, notably in countries like China, where rather than 14% growth, we're now at a little above 7% growth and will be ratcheting downward over the next few decades. Now, one clear symbol of this capital flight or reassessment of emerging markets has been currency depreciation. And the extent of the depreciation has varied considerably country to country. Here's a look at some of the major currencies, but you can see the Chinese renminbi has actually appreciated a little this year. Very little volatility, of course. There's some management behind that. But you look at South Africa, one of the sharpest declines. Indonesia, not on this chart. Turkey, also very significant declines. The red line is Brazil. Brazil has had some recovery thanks to some very sharp interest rate increases. Russia has had kind of more gradual depreciation. I think that reflects a very poor investment environment, but offset by some other pluses, like a sizable current account surplus. But clearly some of the most exposed countries are those that depend on external financing, and this chart kind of selects about 9 of the top emerging markets and takes a look at their current account balances, those blue lines, and their fiscal balances. Externally held debt, and particularly short-term debt, is a vulnerability. I don't have that here, but that certainly is related to the fiscal balance. And if you look at some of the worst cases, Turkey, South Africa, India, Brazil, Indonesia, you can see these are also the countries that have had very substantial currency depreciation, particularly during the May to July period. And in contrast, if you look at China, still a substantial current account surplus. Mexico, the peso has been relatively stable compared to, say, the Brazilian real. Smaller current account deficits, but still a significant fiscal deficit. And of course, with currency depreciation comes upward pressure on prices. A number of factors have contributed to the inflation outcome, but clearly in some major emerging markets, high rates of inflation are limiting policy options during this slowdown. In other words, monetary policy has been focused more on preventing capital outflows. So we've seen interest rate increases in a number of countries like India, Indonesia, Brazil, or other measures to kind of withdraw liquidity. India has a chronic high inflation rate, 9.5% measured by consumer prices, less by the wholesale price increase, which is perhaps the standard for measuring inflation in India, but nevertheless we've seen some acceleration in wholesale prices as well. But very high rates of inflation in Indonesia, Turkey, Russia, South Africa, Brazil, above target rates in most of these countries. In contrast, relatively mild inflation in some other emerging markets. Poland is a good example, tied tied in many ways to Western Europe with only 1% inflation. China, a little over 2.5%. So now I'll just take a quick tour through different regions of the world and highlights our outlook for the key emerging markets in those regions. Latin America, in many ways, is far more stable than in the past. Think back to the 1980s and the volatility of that decade. And the primary reasons are those cited in the first bullet: sound macroeconomic policies, improving debt profiles, substantial foreign exchange reserves have given the region some policy flexibility and some immunization from emerging market volatility. Prospects are especially bright for those countries that are attracting inflows of foreign investment, like Mexico, Chile, Colombia, Brazil, Peru. Policy mismanagement and resource nationalism, in contrast, will restrain growth potential in some other countries. So I'd say most notably if you look at the outlook, the recent performance of Venezuela and Argentina, you can see essentially the failure of socialism of the 21st century. Let me just move to the outlook. These are real GDP growth rates by country. And you can see very strong prospects in countries like Peru and Chile and Colombia. Mexico, although Mexico has had very sluggish growth this year, with the U.S. economy moving into a higher gear, we hope next year, Mexico's growth should pick up. And in addition, President Peña Nieto has introduced a number of reforms very rapidly in education, labor markets, energy, communications industries that should help to support long-term growth. Brazil is coming out of a period of very sluggish growth, but the near-term prospects are, again, cautious. Asia-Pacific will continue to lead global growth. This region has over half of the world's population. Like Latin America, the region certainly has made progress since the crises of the late 1990s. And for a number of reasons, we're not likely to see a replay of that volatility. Debt levels are lower, foreign exchange reserves higher, exchange rates are more flexible, and banks are healthier. But in a number of cases, governments have not used the intervening years since the 97-98 crisis to restructure their economies and become more self-supporting and less dependent on export growth. India and Indonesia have been hit particularly hard this year by capital flight and currency depreciation. But I'd say our long-term outlook for both economies is favorable, maybe certainly a bit riskier in India, given the very fragmented political system and resistance to reforms such as liberalization of foreign direct investment rules. Probably the majority of states oppose many of the liberalization steps, and this will kind of slow the pace of reform, but Nevertheless, India certainly has great potential. Indonesia as well. Perhaps the recent experience will be a reminder that the country needs to do more to open markets towards for global competition and global investment. In China, financial deleveraging and investment consolidation will restrain growth, but we see growth bottoming out this year. There won't be a significant pickup, and longer term there will be deceleration. So by 20 years from now, the growth rate might be closer to 4% than 8%. But clearly the problems with shadow finance have exposed a very high degree of leveraging in China, and this creates some downside risks. Property markets have, to our surprise, heated up a bit this year. Clearly, there are risks of a property market bust, which then would have implications for local governments as well as the banking system. But generally, we're quite optimistic about the ASEAN region with strong domestic demand growth in a number of economies. The Philippines is certainly one of the leaders. Malaysia, Thailand, Indonesia all have very robust growth. And also, the deepening of financial markets will help consumer markets to develop, which is clearly an important adjustment process. So here's our outlook for growth. You can see that China's growth near term holds up in the 7 to 8% range. India gradually picks up from very weak growth in the fiscal year that ended March 31st. And in China, I think we see gradual shifts from external demand to domestic demand, again, happening very slowly. Development is shifting from coastal China to inland China. The urbanization process is proceeding and clearly is a priority of the new government. For a number of reasons, we'll see the growth shifting from the industrial sector to the service sector. Energy and pollution are part of that story. If you look at the strategic sectors that China has identified, they might be some of the same sectors that we'd target in the U.S. and particularly in Silicon Valley or Boston. Emerging Europe. Emerging Europe has certainly been held back by the problems of the Eurozone, given the close linkages to that region. Weak exports, diminished capital inflows, limited credit availability have been part of the story. The economies with the tightest trade and finance linkages have been hit the hardest. The Czech Republic, Hungary, Slovenia are examples. We're beginning to see a turnaround. The Eurozone managed some growth in the second quarter. We think the recovery will continue, albeit at a very sluggish pace. Poland has been kind of the stalwart of the region, managed to grow in 2009, but it recently has seen some deceleration, both in external and domestic demand, and a pronounced slowdown in construction activity. But Poland our outlook for Poland is favorable as export markets strengthen and foreign direct investment continues. One aspect of Poland is the development of shale gas resources, which will help to reduce dependency on energy imports, somewhat analogous to the U.S. situation. Turkey is clearly a trouble spot currently, in part due to social unrest, a very unpopular government, deteriorating Syrian situation, and the refugees from Syria, a huge current account deficit, extreme dependence on capital inflows. So the immediate prospects for Turkey are not that bright. And then in Russia, very disappointing growth. High inflation has kind of hurt consumer purchasing power, which has held back growth. Also, the investment climate has not really improved that much with Russia's accession to the World Trade Organization. So here's kind of a look at kind of the major economies. You can see that if you focus on those brown lines, 2016 to 2020 growth, Poland, the Czech Republic, Hungary, and Turkey all have fairly bright longer-term prospects. Sub-Saharan Africa is one of the fastest growing regions of the world, although in terms of contribution to global GDP, it's quite small. Commodity export revenues have driven the region's growth. This is also a vulnerability, however. Macroeconomic management is improving, poverty is declining, foreign direct investment is rising. So for all these reasons, we expect 5% growth to continue, but clearly there's some challenges. Poor infrastructure, political instability, corruption remain obstacles to development. And South Africa also is hit with a number of problems, labor strikes, labor market rigidities notably. But here's a look at growth. You can see that among the major economies, we have fairly bright prospects for Nigeria and Angola. If you look at some of the smaller countries, Ghana, Mozambique, Ethiopia, Kenya, Tanzania, all have bright growth prospects. But clearly, these growth prospects come with substantial risk. And here I just have kind of wind up with a heat map that is based on an analysis of 3 factors that contribute to risk of political violence: war, terrorism, civil unrest. And basically this is based on 8 years of data on particular incidents in every corner of the world, and those areas in red are those areas of highest risk. But there are a number of areas in blue as well. So there certainly are some bright spots. And I'd say that generally over time, we see improvement in these risk ratings. So to conclude, new realities for emerging markets, both structural and cyclical forces contributed to the emerging markets slowdown. Emerging markets had kind of risen on the tide of quantitative easing by the U.S. Federal Reserve and other major central banks. There was no decoupling of growth between emerging and advanced countries. Emerging markets remain somewhat dependent on exports to the advanced countries and between each other. You know, some countries tried to reduce dependencies on Europe and the U.S. by turning to China. That hasn't worked so well in some cases. Macroeconomic management has been sound in general, but there have been too few structural reforms. Long-term structural issues are infecting near-term investments. Clearly, the taper panic was out of proportion to the Fed's near-term tapering prospects. In other words, our view is that tapering will start in December and asset purchases will be totally wound down by mid-2014. But that means maybe 50 basis points on interest rates. Not markets have already anticipated and built in much of that impact. As growth in the developed economies picks up, in other words, as Europe comes out of recession, as the U.S. maybe shifts in gear from 2% growth to 3% growth, emerging markets will have a more difficult time competing for funds, but their export markets will strengthen. So bottom line, a return to the boom years is unlikely, but we will still see very solid growth in emerging markets.
Can you hear me now? Yeah. Fantastic. My name is Vitaly Vexler. I'm a global macro portfolio manager at Beyond Borders Investment Strategies. And I would like to ask you, first of all, thank you very much for your comments. I would like to ask you a question about, like, if you were to talk about 3 countries that you think will grow faster than all others, or I know it's difficult to estimate it at this point, but maybe you discuss during your meetings, you know, countries that do it right. They do reforms, they are likely to benefit from the export growth or maybe internal demand. Like, if you were to say this, what are the 3 countries? Not necessarily the largest ones, not necessarily that everybody is talking about, but maybe some other countries. Thank you.
Well, certainly in Eastern Europe, the Baltics have done well, Estonia, Latvia, Lithuania, coming out of the recession. I'd say Mexico is clearly a country to watch. It's making a lot of the right moves. Chile is a good example historically. In Asia, the Philippines and Malaysia are good examples. And in Africa, I guess I would look at Ghana.
Thank you. Hi, Mike Shiras from EMC Corporation. In years past, we've been talking a lot about China's rise in terms of, you know, their growth and surpassing the United States. Based on everything you said there, so obviously still financially stable, but their growth is, you know, cut down to say 7%. Do we still see the same trend? We were talking 2020 at some point where they would surpass us. Where do you think China is now?
Let's see. Well, China is, let me just double look at my numbers here. Last year, China was about 11.5% of world GDP. And we see China overtaking the U.S. in 2022, when China's growth will be just shy of China's GDP will be just shy of 20% of world GDP. And there are really 3 factors behind that ascension. And it's not just real growth, because we tend to measure, to put everything on a comparable basis, we look at GDP in US dollars. And so there are 3 factors behind that catch-up. One is real growth, another is inflation, and another is currency appreciation. And all 3 of those factors are at play with China. So, you know, if you look at different sectors of the economy, China clearly is a leader in infrastructure investment, fixed investment. If you look at consumer markets, it's going to be decades before China's consumer market catches up with the U.S. consumer market.
Hi, Sarah. Thank you very much for your speech today. My name's David Masterage. I'm from the strategy group at Raytheon Company. And on slide 5, you had mentioned that the globalization golden age is behind us. And I wanted to know, you know, we're obviously not fully globalized. Are there different levels maybe that you would say is easy to attain, you know, a certain level of globalization and harder to get to other levels of globalization? So is it that we've gotten through the easy parts of globalization and the next stages are harder to get to? Or how would you describe, you know, where we are in the whole scheme of globalization?
I think we're well advanced, in part because the U.S. is such a dominant economy. What's happening in the U.S. is part of the story. And one of the elements is the energy boom in the U.S., which is leading to some kind of return of investment and activity to the U.S. to take advantage of relatively cheap natural gas prices in particular. So changes in energy markets are part of kind of the reconfiguration of global activity. But I think we've reached some limits in terms of offshoring manufacturing to areas with cheap labor. As technology continues to improve, labor is less and less a factor in manufacturing activity. And the major traded products tend to be commodities or goods. So I think we will we're seeing a preference for producing near the end markets, and that will continue to be the case. I'd say there's probably still a lot of room for globalization in the services, and some of that will take a reduction in trade barriers, but it will come.
Two questions, one over there and then Victor.
Go ahead.
Okay. Hello, my name is John Zavaggio of JCS Advisors. I was noticing a majority of statistics or your numbers on growth and the link to the currency are dollar-based. Would the picture look much differently if you used a different currency or a cross-currency for evaluation? China against Russia.
When I showed real GDP growth, those were local currency measures. The aggregations were in 2005 US dollars, but there, again, the currencies did not matter. It's just a few of the statistics I cited of share of world GDP. And yes, it matters. And a number of analysts, including those at the IMF and World Bank, look at purchasing power parity. But I think for business applications, market prices are the best way to measure things, since you really can't bank on purchasing power parity.
One of the things that's talked about much, and I didn't quite hear you address it, is this issue of the demographic changes, the aging of the populations in these different areas. How does that, do you think that's going to reconfigure the structural forces at play here? Is labor going to be more mobile? Europe is aging in 2020, right? The median age is, I don't exactly know where it is, but it's certainly up there. So how does that play into your forecasts?
Well, China is one clear example. China has already had fairly substantial increases in labor productivity. So growth will clearly be affected by the decline in the working age population. And we really haven't seen a change in the one-child policy. In India, in contrast, population growth is about 1.5%. Their other forces are at work, such as income inequality and educational inequality. But that more robust growth rate means a much younger population. Africa is a very young continent. That certainly will contribute to some of the dynamism of that continent and perhaps lead to more direction of investment towards Africa. But throughout the world, across emerging markets, I think we've seen declines in birth rates, which is kind of typical of development and rising household incomes. Sir?
Sorry. I think we have to stop with that. Thank you so much, Sara.